Why do we need risk management? We need risk management to reach objectives. And there are 6 objectives here that I want to mention. Protect our capital, specify always the position size and the risk of our trade. We want to actually try to obtain a risk-free trade. What is a risk-free trade? A risk-free trade is a trade with no residual risk involved, so we are not risking our own money. And there are only 2 ways to get such a trade. The first one is to move a stop above or below the entry, depending whether we have a long or a short. And the other would be to take partial profits off of the market so that the residual risk is zero. There are no other ways to get risk-free trades. And you have to get risk-free trades consistently in your trading all the time if you want to be successful. So we also want to last enough in this game to enter the elite 5%. There are other objectives that risk management allows us to reach if we couple it with money management. And this is to increase the dollar risk as our financial capital goes higher, and I would add as our emotional capital goes higher, and reach objectives by becoming aggressive with the use of markets money. And this will be a little bit clearer later on when I'm going to speak about how we can magnify, how we can supercharge our profits using risk management. Now, some people think that their risk is really the trade margin, and this is something that is defined by their broker. It's not defined by themselves. It's not defined by the risk that there is in the market. As I mentioned before, 25% of people do not practice proper risk management. Actually, they don't even know maybe, and they don't use stop losses. On the other hand, I use 1% of risk and less, and this is not my trade margin. This is actually the amount of money that I lose from my account, on my account, if my stop loss is hit. And this has to take into consideration any leverage that I have available and the brokers makes available to me. Let me now introduce the CPF for traders formula. This is a very simple formula for Forex that allows you to calculate the position size and your risk. It's very, very simple stuff, but I suspect that less than 50%, sorry, there are more than 50% of people don't use these formulas. And there are people who are 2 years, 3 years into trading, and they never use it. So that's the reason, the only reason I decided to put it here. It's very basic risk management. So if I risk 1%, my dollar risk is defined as the current account size times 1%. So if my current account size is 10,000, then I risk $100. That's my dollar risk. The risk for unit is the absolute value of, actually, it's the number of pips that I risk. So it's the entry price minus the stop loss price, and I take the absolute value of it. So in this case, if I have 30 pips of risk, I calculate it using my entry and stop loss price. My entry price in this case is 138.10. This is the euro dollar, ideally. And my stop loss price is 137.80. How many units can I trade? When I speak about units, I speak about lots. So let's suppose I use standard lots, $10 per pip. In this case, my risk, if I have 30 pips of risk, would be $300. And this is bigger than 100, which is my allowed risk, 1% on my account size. So in this case, I cannot even trade one standard lot. So I go down and I look at mini lots, and then I multiply 30 pips for $1, and I have $30 here. And I know here that I can trade 3 mini lots. Of course, I can trade 3.3 mini lots if I consider micro lots. So the lot size, I have to use it's mini. The multiplier is 1, and it's 10 for standard lots and 0.1 for micro lots. The position sizing is given by the number of units multiplied by the current pair price multiplied by the lot size. So very basic stuff. I wanted to give this because a lot of people don't do this at all. So what we have covered so far, the only thing that we have covered is that we have to define the risk of every trade, and we completely accepted the risk. Actually, we hope we completely accepted the risk. But if you risk 1% of your account, it's easy to accept the risk. And if we don't accept the risk, we have to let the trade go. This is very important, very, very important, okay? So at the moment, with basic risk management, as you can see, we only covered some of the truths and principles that are important for proper risk management to make us successful as traders. So in terms of objectives, of course, we cover 1 and 2. We now have something in place that allows us to protect our precious capital. And we also specified the position size of the trade. We still don't know and didn't do anything about obtaining risk-free trades and lasting enough to win this game, and of course increase the dollar risk as the financial and emotional capital goes higher, and also supercharge our profits. So let's see how we can do that. And now that we have our basic risk management fixed and in place, we know also that we can last long enough here, and this is very important. So, but is that enough? No, it is not, as you understand now. It's not, unfortunately, and we have to answer a number of very, very important questions. You have to do this. So, and this helps us by answering these questions, we can actually fill the gap of the missing truths and principles. So what are these questions? First of all, am I trying in the right direction? Path of least resistance. What is happening to price? Do I understand price structure? Do I understand what program trading and algorithms are doing on the higher and lower time frames? Do I understand how professional traders are positioned in this market? How can I obtain a risk-free trade? Again, price structure, I understand what's going on. And price structure is very important. So Rob, yes, trading, it's a trading Bible. Trading in the zone is very, very important. What I did in my years of trading, I took each and every one of those principles and truths, and I kind of embedded into my trading. So when I trade now, following my rules, I know that I respect all those principles and truths, and that's a beauty. So I absolutely agree with you, Rob. So continuing with the questions, am I entering the trade too late? Should I take partial profits off the table, and where if I have to take profits off the table? Can I enter the setup in steps, and can I use this to further limiting risk? And how can I supercharge my profits? I'll show you that you don't have to risk 10% in a trade to supercharge your profits, but you use intelligently money market or your gains from the market. So no need to do that. So let's start. I'm going to give you also some example on charts now. What a lot of people think, they think that what they do, they look only at small time frames. They look at a sequence of 3 to 4 bars, and actually they never understand the big picture. And this is very, very troublesome. I wouldn't be able to trade like that anymore. Of course, when you do that, you find yourself in trouble, and you find yourself trading against the main trend, which is the path of least resistance. So